Good afternoon, everybody. It's Paul here. It's about 1:05, so let's look to begin. Good afternoon to all our rather sort of range of international guests who've joined us today. My name's Paul Wallace. I'm an FX indices and commodities trader, and today is Saturday, the 5th of December, and I'm here to talk about milking your trades. I'm also joined today by Joe Jabbar, who is the head of sales at Valutrades, and he'll be here and happy to answer any questions you may have about Valutrades and their proposition. As always, before we sort of dig into the main elements of our material, we're just going to begin with a quick risk disclaimer. CFDs and FX are leverage products and carry a high level of risk to your capital. It is possible to lose more than your initial deposit, and you may be required to make further payments. These products may not be suitable for all clients, so please ensure you fully understand the risks involved. You can click on the link to read the full risk warning. Valutrades Limited is authorized and regulated by the Financial Conduct Authority, and their financial services register number is 58654. Information on this webinar is not directed at residents or nationals of the United States and is not intended for distribution to or use by any person in any country or jurisdiction where such distribution or use would be contrary to local law or regulation. The presenter is liable for his comments. We do not endorse his views. We are a non-advisory broker, and you should seek independent financial advice. So with the risk disclaimer covered, what are we going to talk about today? Well, I'm going to talk about milking your trades. And what we'll cover for the next 30 to 60 minutes, we'll talk a little bit about the legends of George Soros and Joe Ross. We'll talk about how we milk our trades to add to our profitability. I'm actually going to give you a very simple, clear, and mechanical way to help you build a position. We'll go through a few trade examples. We'll talk about some trade management and risk management, and we'll finish off with any questions that you may have. You're very welcome to ping in any messages or any questions as we go, and I will try and answer them as we go. Or alternatively, we'll spend some time at the end going through all of your thoughts and questions. So let's think. There's a gentleman called George Soros. If you're not aware of him, he's very well known and very well regarded in the sort of the trading industry. Set up one of the first hedge funds. Was a man who's known as broke the Bank of England, where he made I think it was like $1 billion worth of profit in a day in the early 90s, betting against the Bank of England. And what he said was one of his many words of sage advice is, it doesn't matter if you are right or wrong, but how much you win when you are right and how little you lose when wrong. Now, very often in the work I do with private traders, what we tend to do is you find that they actually tend to focus on how often they're right and how often they're wrong. Whereas George Soros, who is an outstandingly successful trader, focuses on how much you win when you are right and how little you lose when you're wrong. The thing is, that is a fantastic quote, and it's one I would suggest you write and print out and put next to your trading computer. But what does it actually mean to us as traders, and how do we actually do that? How do we make sure that we win more when we're right and actually lose a lot less when we're wrong? Well, there's two ways that we can look at that in terms of being able to milk our trade. The first one is that we're always looking for an asymmetric reward to risk ratio in our trades. What does that actually mean? Well, ideally what we're looking to talk about is, whatever we are looking to risk in our trades, we're looking to make a multiple of that in our rewards. And ideally, what I talk about is that ideally we want to operate with a minimum of a 2-to-1 reward to risk. So if I'm going to risk $100 on a trade, I want to know that I'm in a position to make at least $200 in profit. So by actually always looking to sort of trade with that asymmetric reward to risk ratio, that's one of the first things that we can do to help put positive expectancy in our favor. Maybe it's just an opportunity to take a moment to think, if that is something you already do with your trades. Maybe that's something that you've done. Maybe it's something that you've actually haven't done. Maybe you've operated in a different way with actually too much risk for not enough reward. But one of the main things and one of the first things you can do is effectively always look to have ideally a minimum of a reward of 2 for every 1 that you risk. The second way is that we can talk about the major leaps in a trader's equity curve come from when we add to our positions, when it's almost about actually building a position rather than just taking a single trade. The thing is, for most people, talking about adding to their positions is easy. It's very easy to do. It's very easy to sort of chat with other traders and say, oh yes, we always look to add to our positions. But the reality is, especially if you're trading, let's say, intraday short-term markets, how do we actually do it? How can we do it in a way? You'll all know, especially if you've seen over the last couple of days, that when markets move, they can move very, very fast. And what you want is almost a mechanical way that allows you to add to your position in a non-ambiguous manner. And that's where actually one of these other trading legends, Joe Ross, comes in. Some of you may be saying, well, who is Joe Ross? Well, if you've never heard of Joe Ross before, he's known as the sort of trader's equivalent of Warren Buffett. What Warren Buffett is to investing, Joe Ross is to trading. In that he's traded for at least 50 years. As you can probably see by the gentleman's photo. But he's a very well-regarded trader who developed simple tools. Now, I believe, I think Joe is primarily a commodities trader, but the simple tools that he developed, they are known to be instrument and time frame agnostic. What does that actually mean? What it means, and what I'm going to share with you, is tools that you can use regardless of the time frame, regardless of the instrument that you are using. Whether you're trading 5-minute charts on the euro dollar, whether you're swing trading 4-hour charts on the Dow Jones, or if you're trading monthly charts on a commodity like gold. It's about having simple tools that are instrument and time frame agnostic. And one of them, which I use to help milk my trades, is a simple tool called the Ross hook. Now, some of you may have heard of the Ross hook. Some of you may even use the Ross hook. To some of you, it may be completely new. Well, hopefully what we're going to do and talk about today is a way that you can use that to help milk your winning trades to increase your profitability. So here's what we'll do. We're going to go through a bit of a definition of Ross hook. There are effectively 2 definitions. The first one, a Ross hook occurs when the number 2 point of a 1, 2, 3 formation is violated and prices fail to continue in the direction they were moving as a result of the violation. Furthermore, every instance of subsequent failures of prices to move in the direction of the original point 2 violation also creates a Ross hook. What does that actually mean for the first definition? Well, we have here a little 1, 2, 3 pattern. Then effectively as price moves up, it's violated. And the important thing here is as price fails to continue in the direction they were moving as a result of the violation. So after the momentum has pushed us north, then invariably what will happen is that we'll see that price fails to continue in the direction that it was moving in after the violation. And that is what creates a Ross hook. The second definition, and one that may be of interest to you if you're a breakout trader, a Ross hook occurs when prices fail to continue in the direction they were moving, following a breakout from any type of consolidation, which means a sideways market. Furthermore, every instance of subsequent failures of price to move in the direction of the original breakout of the consolidation also creates a Ross hook. So we've had clearly here, you can see a period of consolidation. Price then breaks out, and then invariably, having pushed further north, it fails, okay, to continue in the direction they were moving. That is what creates the Ross hook, and that is what creates the opportunity, the setup for us to actually milk our trades by starting to build a position. So, if that is what a Ross hook is, very simple, very clear. Why do we use it? Well, as I said, Ross hook works equally well in all markets and in all time frames. And I think that's very important. I want you to have a little tool that you can go away, and regardless of what you trade or how you trade, it's something you could look at a chart and start to identify. The reason that it's there is that it reveals a universal truth. Periodically, traders take profits. So after a breakout, there will always be a few traders who start to take profits very quickly, or maybe they scale out. And so the initial move starts to run out of steam. But that basically sets up and shows us a very, very simple setup that we can use. And the good thing about the Ross hook is that you don't need any indicators, you don't need any mathematical formulas or any complications of any kind. You just need to spend a little bit of time understanding, practicing, looking at charts, training the eye to effectively see the setup. And the Ross hook stands on the fact that it exists, and it directly reflects what the market is doing. And that's what we want to, that's where we want to be operating at, okay? Reflecting exactly what the market is doing in that moment. And the reality is there isn't an indicator that can do that. Furthermore, there's nothing to interpret with the Ross hook. It's either there or it isn't. And what's important about that, as I said right at the start, is that actually we want something that if, for example, you're trading intraday timeframes, we want something that is very clear. There is no ambiguity, because when markets are moving fast, the last thing you want to be doing is hesitating, wondering whether that is actually a clear setup. What we want is something very simple, very clear, that provides us with an indication, and then we're starting getting ready to do something. So Freddie's mentioned that it's just what others call a change of polarity, i.e. prior resistance becomes support, or vice versa. That can be one element of it, Freddie, certainly. And certainly if after a breakout price comes back to test that breakout level, then invariably that is a very clear indication of that prior resistance becoming support. But it doesn't even have to really be that. What it can be is just simply after prices moved a certain number of pips, a certain number of points, certain distance, it would be that some people will start to take profits. And as that profit happens, well, then price may fall back a little bit. But invariably what that's also doing is then offering opportunities for others to actually join that trend. There'll be people who've missed the initial breakout. There'll be people who wait for a confirmation of a breakout. And it's by doing that, that's what actually allows us, gives us a very clear opportunity to get on board, to join the trend. You're very welcome, Freddie. As I said, that Ross hook provides a very simple mechanical signal for when to add to our positions. So here's how we use it. Once we're in a trade, we add to our position every time a Ross hook is formed. And what we either do, depending upon our own personal risk profile, is we enter on the break of the Ross hook level, or we enter on the break of the candle when the original momentum returns. And what we'll do is we'll look at a few interesting examples to explain that in a little bit more depth, and hopefully you'll be able to see how these Ross hooks set up, and you'll be able to very, very quickly and clearly start to train your own eyes to identify these opportunities. Because the important thing is that you will find these opportunities exist, as I say, on every type of instrument and on every type of time frame. So it gives you a little simple tool to put in your back pocket that you can use time and time again. And what I found after nearly sort of 19 years of my own trading, after 10 years of helping support other traders, is that very, very simple tools that work in all time frames and all instruments, they tend to, there's a good reason they work, is because they are simple, they are mechanical, and you can use them time and time again. And this is what I try the message I try to get across to people. You want to keep it as simple as you can, because invariably that's what works the best over the longest period. So here's a little setup. This is, I think, a 4-hour chart here. And what we had was that after the initial short entry on our breakout, what we had was 8 Ross Hucks set up as price moved further south. And what that does is provide opportunities to add to your positions. So I'm just going to draw on here a little bit. The original breakout was here. Okay, we were sort of short, or invariably, maybe we're waiting to break out from consolidation. What we see here is this candle here. Price has continued after the first break. Every low of every candle is lower until we move here, okay? When effectively it doesn't. And this creates that Ross hook. But then for the aggressive traders, when the momentum comes back in, that was the opportunity to either A, join the trend, or B, add to your position. Furthermore, or if your risk profile is you prefer to see the original Ross hook broken, when invariably the low of that candle was broken, that would be your chance to add. But what you see here is price moves down, price fails to follow through, and then it does follow through. Follows through there, follows through there. Price moves down, okay? Keeps making, every candle's making a lower lows until this one. When it fails to make a follow low, that creates the Ross hook, and then invariably you enter or add to your position when that momentum re-engages. And it moves down until this next one, where effectively it's been making, every candle's making lower lows until this one, and then invariably what we see is price moves back, but actually what happens is the momentum rejoins, and when we see that break of that candle, we add. And as you can see, that happens 8 times on the way down on this particular trade. So this was a nice trend trade, and so what it does is it provides that opportunity to build a position. Rather than just taking the one trade on the breakout and hope that it goes your way, when you are in a position that it is going your way, it's important to win more when you're right. And by adding to your position using just a simple Ross hook setup, it allows you that opportunity to build that position, to help you do what George Soros talked about right at the very first slide. So here's a couple of examples from my own trading. This was from the Kiwi dollar, okay? For those of you, if you've never seen how I trade, I'm a big fan of the weekly chart, and the majority of my trading is done off that. I'm very much a big picture trader. And the Kiwi dollar has been in pretty much, has been in a strong downtrend, it might be said, for about the last 18 months. And what happened at the start of the summer was that after the move down earlier in the year, we had a little bit of a period of consolidation, what almost looked like a sort of a double bottom before price moved back up to a level of resistance, whereby it actually printed on the weekly chart, it printed a pin bar or a rejection candle, which was also rejecting a level of resistance, which was also the actual weekly bar was also an outside bar, an engulfing candle. So one of the other things I talk to traders about is you're always looking for a confluence of events. You're looking for 3 or 4 things all to come together at one point. And so at that point, that was another opportunity to join the short trend. And so, we had a long-term short position with a target down at the kind of 65 level, which was a long-term support level. So let's have a little look at actually how that trade planned out. If you move down to the daily chart, well, they provided lots of opportunities where we had Ross hooks occurring again and again and again that provided opportunities to either A, join that trend if you were late to the party, or you had the opportunity to add to your position as that trade went down. So what you're doing here is, you're only adding when the actual position, when the actual sort of initial trade starts to work out, when it starts to move in your direction, when a trend is in place. Now, of course, there's ways and means to help work that out, and that'll be undoubtedly the element of one of our future webinars. But what I want to talk to you about here is about when those trades do happen. It's a case of being able to milk your trades. It's a case of being able to build a position. It's a case of winning more when you're right. That is the message that I want you to take away. So hopefully you can see that this was effectively over the sort of the summer, where invariably the US dollar was strong against everything, the Kiwi dollar was weak, and so invariably we already knew we wanted to be short traders of the Kiwi dollar, and this was just giving us an opportunity to actually milk our positions, to milk our trades. So here's one from actually very recently. Once again, it's the weekly chart. As I said, I'm a the weekly chart. And, I really do. I've traded everything from tick charts to monthly charts, and I realized that the weekly charts for me work very, very well and fit in with my lifestyle. Now, this is actually a commodity. I want to try and show different instruments on and this was the silver, the commodity silver on the weekly chart. And if you take a look at the weekly chart silver, you'll see that not unlike gold, it's been in a long-term downtrend for the last couple of years, and it actually had set up as a very nice descending triangle. And what you'll see if you ever look at any of my charts, as I said, I'm always trying to keep it very simple. I have a couple of moving averages on there just to give an indication of trend, and also to give an indication of dynamic levels of support and resistance. I draw in the sort of the longer term horizontal support and resistance, and then really that's about it. I'm just trying to understand and build a picture of what's going on. And within silver had effectively, after sort of making a low early in the summer, it had pulled back, and effectively what had happened, it pulled back to a getting towards a downtrend line, a resistance level, which was also at a level of dynamic resistance from the 50 period moving average. And at that 50 period moving average, what happened was that silver started to turn around. It created a bearish pin bar engulfing candle. So what we had is, once again, we had a confluence of events of 3 or 4 things going on, and invariably that was giving an indication to short silver, and basically to look at running it down to to its next levels, okay, to those kind of previous lows, which were around about $14.10. Vinod says, do each of these entries have individual stops? Yes, they do, Vinod. And what I'm going to do is talk a little bit about that on the trade management and the risk management. And I'm actually going to break down one of my recent trades to show you exactly how that happens. So hopefully that will give you the explanation. So, as I said, that was on the weekly chart. Now, I actually missed the weekly entry, which I think, if I remember right, it was around about the end of start of October. I was away on holiday, but invariably, once I returned to my trading desk, then I was able to move down to the 4-hour chart and start to build a position. Once the breakout had occurred, I was able to build up a position using what you'll see there termed as the RHAO, and that really just stands for the Ross Hook add-on. So invariably, whenever there was a Ross Hook, I was looking to add to that position. Okay, you can probably see from the arrows, okay, that where there was a Ross Hook, and then there was a chance to add. Where there was a Ross Hook, there was the chance to add. Okay, and that's what we did. And then that actually ran down over the pretty much over sort of October, November time, down towards the $14.10 level, which was our target. So it was just, it's a very, very simple tool, and the important thing is here is, if you like I did in that case, if you miss the initial entry, or if you are a breakout trader and let's say you missed the breakout, or you were looking for confirmation, looking for a Ross Hook is a really very, very simple mechanical way for you to identify these opportunities. As I said, all these time frames, all these different instruments, price will always show up and deliver Ross hooks, and it's there for you to use that as an opportunity to either enter a trade or to build a position. Here's one I wanted to show you a little bit, something a little bit different, but using the same tool. And this is the 60-minute chart, and this is a chart of the French exchange, the CAC 40, and this was from the end of November. And I'm just going to explain, and this is a little bit of a kind of a interesting and kind of relevant moot point. Is that as I said, this is the 60-minute chart. When we see the chart close here, that was the close on the Friday, would have been the Friday afternoon, Friday evening. We had the horrendous terrorist incident on the Friday evening in Paris, so invariably what happened was on the Monday morning when the CAC opened, the CAC initially gapped down. But actually what had happened is, in what we've seen in financial markets over, well, since 9/11, is that markets have shrugged off those kind of quickly, and invariably it's almost as if traders are looking to sort of step in and support markets after such an event. And so there was an immediate gap down, which in itself is a trading strategy. But what happened is price shot up for the first few hours, and then invariably here. How did it create? Well, because invariably these candles here, okay, the momentum failed to continue to make higher highs with every candle. So we actually have a Ross hook here, and then price pulls back, and then invariably when momentum comes back in, that Ross hook sets up, and then price actually dropped about 3 bars, and then when price momentum returned, it broke the high at 48.01, and I always add a couple of points on the indexes just to break above when I'm buying, and invariably there was an entry there at 48.03, and then price ran all the way up to the 200 moving average on the hourly chart. So I just wanted to show you even like a little bit of a different example of how you can use Ross hooks to if you had missed the let's say buying the gap early on, it was clear that day that such was the sentiment within the market that invariably that market was only going to go one way, and you were looking for a little bit of a pause, a little bit of a pullback, and an opportunity for you to actually engage and join that market. So I'm just going to, this is the kind of last example, but what I want to do, and this is to basically to help a Vinod as well. What we're looking to do is that I'm going to try and break this down in terms of the way this trade. Freddie asks, can you explain the actual mechanics of building position? It seems to me you're averaging up in an uptrend and averaging down and downtrend. So if you get a sudden reversal, you could lose all your profits. Okay, well, we're not averaging down is normally termed, Freddie, as adding to a losing position. That's not what we're looking to. That's not what we're looking to do. We're only looking to add to winning trades. And so what I've done here is I've shown you a breakdown from a trade in September. This is the Aussie against the Swiss franc. So that's very kind of you, Kenneth. Thank you. So what we hear is Aussie Swiss franc is in my terms what is called S1S, which basically that's my own trading style, which tells me that strength, trend, and momentum are very strong to the downside. And so invariably I'm looking for an opportunity to trade Aussie Swiss to the downside. So I'm looking for opportunities to be a seller of Aussie Swiss. Then what actually happened is on the daily chart, okay, moving down from the weekly to the daily chart, what happened was it created an inside bar on the daily chart, which starts to get me interested. But then actually as you zoom down to the 4 hour, what I had here, I'm just going to go where the arrow was that effectively what we had was a pin bar off dynamic resistance from the 200 moving average. That was a great opportunity for me who wanted an opportunity to be a short seller to take the short trade. And my initial entry was the break of that low, and so my entry was at 69.18. That's my target. My initial stop loss is 69.48, and my target, okay, is down here at 67.76. Now, what actually happened is, as price moved down, as we see, price never moves in a straight line. Price always moves in a zigzag. And what I wanted to do was, as the opportunities arose, I would look to try and add on to this position. And what I've done is shown all the add-ons that were there. Now, admittedly, because I have traded like this for many years, I'm comfortable and confident enough to effectively to trade the let's say the kind of the Ross hook. As soon as the low or the high of the bar is broken, I'm happy to actually add to my position there. I don't need to wait to see the let's see that in this particular case the low of the actual Ross hook to be broken. But what that happens is that comes from confidence, and you know, I could talk to you, you know, till the cows come home about confidence, but unfortunately in trading, the only way you become confident in something is to actually to do it. There is no there are no magic potions. There are no books, you know, you can really read. If you want to become confident in a particular trading style, the only way you become confident in it is to actually to do it, you know, and to test it. What I like to perceive as what they call forward tests. So actually, you know, I will get an idea, I will forward test it by actually starting to just test it, to trade it on demo, and if it continues to give me good feedback that I'm able to analyze, then I can use that to start to trade that live. And I trade that live very small, the smallest I possibly can. Build more feedback, I build more data, and as I can see whether that idea has merit, then I can add and build that into my trading plan. And of course, by doing that, that's what builds confidence. There is no other way to become a confident trader than to actually to work at it, to do what needs to be done. So a little bit of trading performance there as I diverged, but what we're going to do is going to break down this trade here. Now, I'm hoping you might be able to read this. If not, I'm sure it'll be on the website for you able to actually to chat, to investigate and look. But as I said on the first one, my initial position, okay, I had an entry of 69.18 with a stop of 69.48. So what I have there is I have my what I call my trade risk, which is the number of, let's say, the number in FX, the number of pips I'm risking. So my risk was 30 pips, and my initial target was 67.76. So I'm risking 30 pips for a possible reward of 142 pips, which is going to generate me 4.7 R. For those of you who are experienced traders, what you'll realize is that we talk about measures of risk, or units of R, units of risk. Okay, so 4.7 R is effectively, you know, is 4.7 times my trade risk of 30 pips. My capital risk, okay, is 0.5%, half a percent position. Okay, so I know what my trade risk, I know what my capital risk. Trade moves, the trade triggers, and it starts to move down. And then effectively what we have is we have the opportunity to add on. The first opportunity to add on, well, the entry of that is 68.88 with a stop loss of 69.18. Once again, just the way that particular trade works out, that my risk is 30, my trade risk is 30 pips. My reward would be 112. I'm still using the same target, but my stop loss is effectively sort of the high of that particular bar. Here's the interesting thing, is that my capital risk is 0.25%. It's half of what my original position is. We're gonna have a couple of slides about that, but I'm gonna go. I'm gonna make no apologies by repeating it again and again and again and again. When you add to your positions, okay, when some people do it, what they like to do is like double up and double up and double up. That is not a smart way to do it. Okay, as a rule of thumb, in terms of your capital risk, your add-on position should always be half your existing position. So that's what we've got there. Trade risk of 30 pips, capital risk of 0.25. Then price moves down, but it pulls back again. It puts in another Ross hook, and the second add-on you could have added was down there at 68.53. In this case, the actual trade risk was 44 pips. with a reward of 77. But look at the capital risk. The capital risk would be only 0.125%. Okay, half of the position before, which is half of the position, the initial position. And then the final add-on, third add-on, would be at entry was at what, 68.38. Here again, the trade risk, okay, was 29 pips. But once again here, the actual position, the add-on position here in this case was 0.125. That's because invariably what happens is you get to such a small level that you're unable to actually add. But the whole idea is that it's getting smaller and smaller and smaller. So you can have a look and read at what the actual, the position would have been on that. In reality, what happened was that I took the initial position and I was only able to do the second add-on position. Okay. The reason being is that the other two add-on positions happened overnight when I do actually get to sleep sometimes, so I wasn't actually there. But what actually happened was, for the overall position, my total risk was 2R, 2 units of R, and invariably the result was generated plus 6.4R. I risked a total of the initial position and the add-on 74 pips and generated 215 pips of profit. And in terms of my percent risk, okay, my capital risk was a total of 0.75%, and the profit was 0.2 plus 2.78%. So hopefully you can see, even with just the almost like the one add-on, what I'm doing is I'm milking my trade. Okay, I'm actually building a position. I'm actually starting to try and, as George Soros says, to win more when I'm right. The tight stops basically I use the actual bar that is the entry bar for me. I'm just looking to place the stop at the other side of that particular bar, just keeping it nice and simple. What I actually do is I'm almost a set and forget trader, Freddie. Okay, as in I am happy once the trade is on, okay, and once the trade is moving in the direction, I'm happy to actually just let the trade play out. Now, that once again is not something everybody else is comfortable with, but it's something that over years and years of trading, I am comfortable with. The reason I'm comfortable is because I have confidence. Why do I have confidence? Well, because I know my numbers, I know my performance metrics, and yeah, that might be the subject of another webinar in the new year about understanding trader performance metrics and the kind of how that helps with your building self-confidence and self-belief. So, as I said, I'd finish off with a few slides about trade management and risk management. Before you get too excited about looking at this as a way to attain that Ferrari, okay. What you'll find myself and Valutrades are always very, very keen to stress is it's always important to manage your risk. This is not about doubling down or adding to your losers, okay? Not remotely, okay? When they talk about normal risk parameters, the kind of generally accepted sort of, let's say, conventional wisdom is that, you shouldn't really be looking to risk more than 1% on a trade, okay? Now, here's what I do. I never risk more than 1% on a trade. And actually, because of position, account size, invariably, most of my account trades is either normally about 1/4 or 0.5%. But what I can do is within my trading business plan is that I never risk more than 2% on a position. All right. And when I define a position is a group of trades and their add-ons. So that Aussie, Swiss, those New Zealand dollar trades, of silver, that becomes a position. And I'm always never looking to risk more than 2% on a position. Okay, so I'm still demonstrating very, very strict risk management and trade management. And as I said earlier, the way we do it is that each Ross Hook add-on should be half the capital size of the preceding trade. Okay, that's the way we look at it. Each Ross Hook add-on should be half the size of the preceding trade. So If you need a little reminder of that, if you need to sort of have a constant reminder that's the way we trade manage and risk manage, well, get yourself a US $1 bill, which is no bad thing for no bad side for FX traders amongst us. And you can see on a US $1 bill, especially if you've read any of the Dan Brown novels, okay, that you'll actually be able to see that sign. And what I want you to do is to think of it almost like the pyramid from the US $1 bill. In that, each layer of your position should be smaller and smaller. Just like a pyramid, the layers in a pyramid are smaller and smaller, so should your capital risk. And what you need also is you need to keep that all-seeing eye that is vigilant over it all, because at the very ends of trends, things can reverse very, very quickly. You only have to have a look at what actually happened on Thursday to see that within markets. So as you build that position, you invariably are able to keep an eye on it. That's one of the reasons I always have targets for my trades, and that's the target I'm always looking to hit for all of my trades within a position. So Freddie said that's the point I was trying to make out. If your target would narrowly missed and price reversed by not trading stop, you might have lost a lot of your profits. And that is very true. And as I said, that's one of the reasons that I have targets set for myself, and that's why I'm also, I will trail once my position starts to build up. But originally, that's not for my initial sort of trade. That's not what I'm looking to do. I'm looking to allow it to breathe. But invariably, if you're trading, like I do on sort of the weekly, the daily, the 4-hourly charts, invariably, when you do find some of those very good trends, they can actually run for for weeks and months. And so what I want to do is to be in a position to ride that. But I still have targets and targets, and all of the trades have that same target. And I'm very happy to, once I've hit a target, to step aside and take my position. I don't, I don't sit there looking at afterwards thinking, oh well, that position went on. It could have gone on another couple of 100 points. I have learned over the years that I plan my trade, I trade my plan, I manage my risk, and that's me. And if I do that, those are my definitions of success. And if I've hit my targets, I'm very happy and satisfied that I have operated like a good professional trader in terms of planning my trade, trading my plan, managing my risk. So just to sort of bring us towards the end, just remember the first slide I put up was from George Soros. It doesn't matter if you're right or wrong, but how much you win when you're right and how little you lose when you're wrong. And hopefully what I've done over these last sort of 40 minutes is give you a little bit of an insight into one of the ways you might be able to help yourself do that. Maybe you've thought about it, or maybe you've read about it, or maybe you've heard other traders talk about, oh well, I always look to ride my winners and add to my positions. But hopefully what I've done there is given you a little sort of a demonstration of a very simple mechanical way that you could actually do it. And as I said, it doesn't matter whether you're trading 5-minute FX, you're trading medium-term swings on indices, or you're trading long-term positions on commodities. Okay, it's about having a simple mechanical way that you can add, so that you can sort of win bigger when you're right, and also keep your losses small when you're wrong. Sorry to keep asking questions, Freddie. What do you do if your add-ons start getting stopped out? It's not unusual if, sometimes if there is, as you say, if there is a bit of a move, and what will happen is I will invariably use that as think of it as that kind of all-seeing vigilant eye. That's my time to start keeping an eye on and looking at the price action. Has the overall trend ended? Is it giving me, let's say, reversal patterns in the opposite direction? And that's what I'd be looking at. Okay, to use that as it's almost like a tripwire that starts to get me identifying, whether that particular trend is over. What I've learned is that trends tend to undershoot and overshoot. Okay, I never try to call the exact bottoms, because actually the tops and bottoms, because actually human beings are actually pretty rubbish at that, because trends tend to undershoot and overshoot. But what I will do is I will look to sort of manage my risk on my position accordingly if I'm starting to get an idea that invariably, let's say the overall trend momentum is starting to fade. So, as I said, just to conclude, what we talked about was that we had a little bit of a talk about George Soros and also the Joe Ross, and in particular the Ross hook that hopefully gives us an idea about how you could milk your trades to add to your profitability. As I've said many times, I want it to be a simple, clear, mechanical way for you to add. And the important sort of just risk management element is that each trade should be half the previous size. This is not about trying to like an inverse pyramid to try and to do some super large trade. Not at all. Okay, we still are operating within very clear risk parameters. We're still operating in a very very mechanical, very methodical, very process driven way, and that's the way most of us would trade best if we were to follow that. So finally, ladies and gentlemen, hopefully, you can take away, a few action points for you to have a think about. So, why don't you go back and have a look at some of your previous winning trades? Okay, why don't you just sit down, think of them, have a look at them. Now you know what a Ross hook is. Think about, were there opportunities to add to those winning trades? Were there any Ross hooks that set up? Had you done that and had you added to it by just using the rules that we talked here, what impact would that have made to the result of that position? And also, what effect would it have had on your overall profitability? And could you spend the rest of your weekend or the next few days devising a few tactics to add to your own existing trading plan to start to build in that kind of simple mechanical way to start milking your trades? So hopefully that'll give you a little bit of something to think about. So as always, I just draw it to a close there. I'll happily take any questions if there are any remaining. As always, success with your own trading, ladies and gentlemen. And I hope the markets treat you well, and I hope the remainder of 2015 is profitable and favourable for you within your own trading endeavours. Thanks, Malta. Thanks, Andre. You're very kind, Bernard. Freddie, thanks. You're very kind, Kenneth. Thank you very much. Yes, thank you all for attending, ladies and gentlemen. I hope you found that useful, and I hope that's given you some great food for thought for the rest of your weekend.